If you're a UK taxpayer planning family gifts, this is for you. You'll learn which gifts HMRC may still review. I'm from PTA.
Imagine a founder with a £3.5 million business unexpectedly loses mental capacity. Their appointed attorney steps in and attempts to rapidly transfer £2.5 million in shares to the next generation to shield the estate from taxes. The transfer is immediately rejected, triggering a £500,000 penalty. The attorney assumes the lasting power of attorney, or LPA, grants them the legal right to unilaterally bypass the incoming 2026 HMRC tax changes on behalf of the founder. That assumption is false. An LPA does not authorize tax avoidance. Attempting to use one for that purpose triggers severe financial penalties and immediate legal investigation. At Pro Tax Accountant, we advise UK business owners and contractors on complex corporate structuring, compliance, and tax planning. Today, we are analyzing the direct conflict between the legal gifting limits of an LPA and HMRC's strict new inheritance tax avoidance thresholds coming into effect in 2026. We will detail the exact mechanics of the new £1 million business property relief cap, define the rigid constraints of fiduciary gifting, and outline the specific legal exemptions required to keep your business intact. Failing to reconcile the legal limits of your LPA with HMRC's new thresholds before capacity is lost guarantees maximum tax exposure for your estate. The catalyst for this exposure is the UK government's decision to freeze the standard inheritance tax nil rate band at £325,000 until 2031. Because inflation pushes asset values higher while the tax-free allowance remains static, HMRC is actively capturing more estates. To accelerate this, the government terminates unlimited 100% business property relief, or BPR, in April 2026. This financial threshold chart maps out the new rules. Under the 2026 system, only the first £1 million of qualifying business property retains full 100% tax relief. Any business assets exceeding that £1 million cap receive only 50% relief. Because standard inheritance tax is 40%, applying a 50% relief to the excess creates an effective 20% tax rate on everything above the £1 million mark. Let's apply this to a £3 million SME. Under pre-2026 rules, this business faces exactly £0 in inheritance tax. Under the post-2026 reality, the first $1 million is protected. The remaining £2 million excess is taxed at that effective 20% rate. That generates a £400,000 tax liability on the estate. These rules also target unlisted shares, specifically those traded on the Alternative Investment Market, or AIM. AIM shares face a flat 50% relief reduction in all circumstances, regardless of the portfolio's total value. This specifically captures contractor investment portfolios that previously relied on AIM shares for complete tax protection. Relying on historical business property relief rules for an estate distress SME in 2026 creates an immediate, unfunded tax liability for the succeeding generation. The standard defense against a looming tax liability is to gift assets early. However, under an LPA, a gift is broadly defined. It includes selling property below market value, transferring startup shares, or waiving corporate debts. By law, an LPA does not grant an attorney the authority to execute strategic IHT mitigating business transfers. The powers of an attorney are heavily restricted by Section 12 of the Mental Capacity Act 2005. This scale graphic visualizes the disconnect. While families assume an LPA provides blanket authority over finances, the law dictates that attorneys can only make gifts on customary occasions, like birthdays and weddings, or to charities the donor previously supported. Even those customary gifts must remain reasonable in value, measured strictly against the overall size of the donor's estate. Any major wealth transfer executed by an attorney, like moving company shares to avoid the £1 million BPR cap, requires prior authorization from the Court of Protection. By law, an attorney's fiduciary duty is to protect the donor's best interests while they are alive. That duty acts as an absolute legal roadblock to strategic corporate tax avoidance for the heirs. The Office of the Public Guardian, the regulatory body overseeing LPAs, does provide de minimis exceptions to allow minor gifting without court involvement. These exceptions are limited to the standard £3,000 annual exemption and the £250 small gifts exemption per person. To use them, the attorney must prove the estate exceeds £325,000. The donor's life expectancy is under 5 years, and the gifts will not impact the donor's ability to afford their own care. These micro-exemptions are entirely useless for transferring company ownership or executing systematic inheritance tax planning for a multi-million-pound business. When the exemptions fall short, the only remaining option is filing a formal application to the Court of Protection to move the business assets before the 2026 cliff arrives. Navigating a Court of Protection application is a highly scrutinized, costly legal battle. Applications designed to reduce the beneficiary's future tax bills are rarely approved. The court evaluates the application based on the donor's needs. Funding the donor's lifetime care takes absolute precedence over minimizing HMRC's eventual cut of the estate. Relying on a reactive Court of Protection application is a failing strategy. The delays and high rejection rates will leave the business trapped exactly where HMRC wants it, exposed to the new 2026 tax rate. There is one powerful, legally compliant tool available to a fiduciary's managing an estate under an LTA, the exemption for normal expenditure out of income. This financial funnel diagram illustrates the criteria. First, the gifts must exclusively originate from surplus income and never from the donor's capital assets. Second, the gifting must form a demonstrable, regular pattern over a sustained period of time. HMRC looks for an established rhythm, not an isolated transfer. Third, the gifts must leave the incapacitated donor with enough income to maintain their standard of living and fully afford their ongoing care costs. For example, if an incapacitated contractor continues to draw a high regular dividend income from their company, their attorney can legally gift the surplus of that income to the family. Because it qualifies under this exemption, this surplus gifting remains completely outside the inheritance tax net. Crucially, it does not consume any of the £1 million BPR cap. A professional tip: to survive an audit from the Office of the Public Guardian, or HMRC, the attorney must maintain a meticulous gift register, documenting the source of funds and the affordability of every transfer. Bulk capital transfers are legally blocked by the Mental Capacity Act. Meticulously structured surplus income gifting is the safest, most effective tax relief valve available under an LPA. To prevent business owners from bypassing the £1 million BPR cap, HMRC has introduced new trust regulations explicitly designed to stop asset fragmentation. This diagram shows the new mechanism. There is a £2.5 million combined allowance cap applied across all trusts created by the same settlor after October 30, 2024. You can no longer split assets across multiple trusts to multiply your tax reliefs. This interacts dangerously with potentially exempt transfers, or PETs. A PET is an outright gift that only becomes tax-free if the donor survives for 7 full years after making it. If a startup founder makes a substantial outright gift to their children but passes away within that 7-year window, the transfer fails. If that death occurs after April 2026, the failed PET retroactively consumes the new allowance caps, severely restricting the relief available for the remaining business assets in the estate. Poorly documented or legally unauthorized transfers made by an attorney under an LPA will trigger these trust rules, weaponizing tax codes against the entire estate. The £1 million BPR cap alters the mathematical reality of UK business succession. The days of unlimited relief are over. At the same time, strict limits of the Mental Capacity Act legally prevent your appointed attorneys from executing reactive tax plans once you lose capacity. To insulate your business, you must execute proactive corporate restructuring while you still have capacity, and ensure your attorneys are trained to strictly utilize the surplus income exemption later. If you are a business owner, startup founder, or contractor, contact ProTax Accountant ahead of the April 2026 deadline. We will review your corporate structure and ensure your succession planning is compliant. Visit our website using the link in the description and subscribe to the channel for ongoing high-level analysis of UK corporate tax strategy. This video is for educational purposes only and does not constitute financial or legal advice. Always consult a qualified professional regarding your specific circumstances.